Inflation cools, but did the market overreact? Today's headline: Inflation is certainly cooling. Good news might be bad news for housing. Also, did the market overreact? And we're not talking about stocks. Finally, a warning: the 1 year treasury bond. It may be signaling some trouble for us in the future. On the month over month, the consumer price index was reported to have declined, down 0.1% to the negative. It's the first negative reading we've seen in quite a while, several years, following last month's zero report and prior to that, zero point 0.3. Certainly good news for those of us hoping for lower inflation. On a year over year basis, the consumer price index also declined, down to 3%. Last month's 3.3, that followed the prior month's 3.4 and 3.5. This is the third consecutive month with declines in inflation on a year over year basis. Also good news. But does the good news, could that be bad news for the housing market? Notice there are different sectors reported within the Consumer Price Index reports. In particular, the weakest segment is CPI durables. We think about durable goods, those goods that are meant to last more than 3 to 5 years, things like washing machines and appliances, directly correlated to the housing market. If we've seen such a decline in prices in those durable goods, that probably tells us there's a lack of demand for these new appliances. There's a lack of demand, possibly because there's just a lack of consumers out there buying new homes. That is not good news, especially in contrast to all the other sectors which have been so strong. Think about it. We see inflation everywhere except durable goods. Did the market overreact? Now we're talking about the futures market, not stocks. But in terms of the stock market, we are seeing a possible sector rotation. If you watch the markets today, you'll see strong stocks like Nvidia, Apple. They've been very strong. Weak today. Nvidia down over 5%. What was strong today? Interest rate sensitive stocks like banks and utilities. Here on the right hand side, the XLU, that's utility sector spider. Now, does this trend continue? That'll be left to be seen. But there definitely was a market reaction, money moving out of those tech stocks that are less affected by high interest rates and into those interest rate sensitive stocks, which had a good day today. What are the odds of a September rate cut now? Currently 93%. Notice we spoke about this yesterday. The biggest move to the upside in terms of the odds the Federal Reserve would cut interest rates, that occurred on July 5th. That was a non-farm payroll report. Remember, the non-farm payroll report was weak. Jobs are slowing. That brought us up to 78% chance that the Federal Reserve would cut rates in September. But today's CPI number gave us confirmation. Inflation's also cooling. We have now a 93% chance the Federal Reserve will cut rates in September. Now, this is interesting. This shows us that today's change in terms of the different futures contracts, this is measured by the Fed funds futures. We're going to show you how to read this and what this means. Number one, the odds of no change in September dropped 19%. That means, will the Federal Reserve cut rates in September? The chances that they would not cut rates was moderately high, but now it's 19% lower. So the money is moving out of the category that the Fed will not cut rates. But notice where the money went. The odds that we'll see a quarter point cut that will bring interest rates down to 5 to 5.25, they're always quoted in that range. The odds of a quarter point cut in September rise by 15%. So the odds that the Fed won't cut rates go down by 19. They will cut by a quarter. That's up 15%. Okay, that's logical. But notice this, and this is the market overreaction. I don't know that anybody else is talking about this, by the way. The odds of a half a point cut, or that the interest rates will be half a point lower now, the half a point lower in November than they are now, that rose 17%. In fact, notice that the odds that we'd have a 5 to 5.25 range in November, that actually dropped. There's not a good chance by November we're only going to be down a quarter point. No, the Fed funds futures say that the CPI number was so weak today, we're going to be down half a point by November. Now, keep this in mind. It's also an election year. It's not really a popular thing for the Federal Reserve to be making large adjustments in interest rates. It can be perceived as political. Nevertheless, the Fed funds futures don't care. They're saying that we're going to be down half a point from current levels by November, but that's not all. We're going to be down by 0.75 points in December. Those futures rose 18%. That will be in the 4.5 to 4.75 range in December. That, I don't know if that's a market overreaction, but that is a stark shift. Usually we'll see that, the odds in September will move a couple points, but the fact that the market is now predicting 0.75 points lower by December, that's a stark contrast to where we were just a couple days ago. By the way, the bond-year treasury, that could be in trouble. Well, not that it's going to be in trouble. We could be in trouble. You see, here we have still the inverted bond market. The inverted bond market occurs when the short-term yields, like the 1 year, currently paying 4.89, pay a higher yield than the long-term maturities, like the 10-year, paying a 4.18. Okay, that's the inverted bond markets. That still continues today, which, by the way, is not good news in and of itself. But we see overall treasury yields are falling, especially lately. In the last month or so, we've seen all the different maturities. Those yields are going down, but not every maturity is created the same way. So we have to make note of the differences, which we're going to show you right now. This is today's change in the treasury market. Notice what moved to the downside the most: the 1 year and 2 year, the short-term treasury notes. Now, they're moving for a different reason than the long-term bonds, which we're going to show you right now. Here in gray, S&P 500. In blue, that's the 1 year treasury notes. In red, 10-year treasury bond. But this is 2007. This is not now. Let's show you what happened back then. Notice the 1 year in blue. That's the 1 year treasury yield declined, anticipating lower rates were coming soon. This was, mid 07. Now, the short-term yields, like the 1 year, they are more closely linked to Fed funds, meaning that when we see now there's a growing anticipation, a 93% chance the Federal Reserve is going to cut rates in September, that affects the 1 year. The 10 year more closely reflects the anticipation of long-term economic conditions. In this case, in late 2007, the 10-year treasury declined also, anticipating a weakening economy. Now, the 1 year moved down more. Think about it like this. The 10 years telling us there's trouble in the horizon, but the 1 year telling us there's so much trouble that the Fed's going to cut rates soon. Well, what's the alternative? If we had seen the 10 year, let's say, stay flat, that the long-term outlook is not bad, it's not good, it looks okay, it doesn't really concern us, but the 1 year was going down, well, that would tell us, yeah, the Federal Reserve's got to lower rates, but it's going to be a soft landing. It's not a big deal. And we're probably going to be off to a new economic boom after that. But that's not what happened here. Both yields are going down, but the 1 year was moving faster, anticipating the crisis was coming soon. And boy, was it right. By the way, click on our on the YouTube page, click on community, and you'll see a question. The Fed funds futures currently predict interest rates will decline by 0.25 point in September, 0.5 point by November, and 0.75 point by December. Do you think the futures market has it right? Do you think the projections look good? The Fed is not going to cut rates so aggressively, but maybe a little bit. The Fed is not going to cut rates at all this year. The Fed will be even more aggressive. The economy really needs to help. Vote on our poll. It'll be very interesting to see if those of you that watch us agree with the Fed funds futures. And by the way, yesterday we put together a pretty interesting little piece. It's called the recession indicator. We're talking about a very not very often discussed indicator called the SAM rule, which measures the rate of change in the unemployment rate. It happens to be an excellent predictor of recessions. We took a look at charts going back about 30 years or so. It's a pretty interesting discussion. I think you'll find what we found here to be quite interesting.